Good afternoon, and welcome to today's teleconference on the Pacnet acquisition. My name is Peter Copponetis, and I'm responsible for investor relations at Telstra. Also on the line today is Nicole McKechnie, who is responsible for media. The presenters today will be Telstra Chief Financial Officer and Group Executive International Andy Penn and Brendon Riley, Group Executive Global Enterprise and Services. Today's presentation will be followed by a Q&A session with Andy and Brendon, both for analysts and for media. In terms of the format for today, we won't step through the pack which has been lodged on the ASX. Both Andy and Brendon will go through respective presentations. And with that, I'll hand over to Andy.
Thanks very much, Peter, and thank you everybody for hooking in today. Let me just acknowledge it's probably closer to Christmas than we all would like, but we were keen to get this transaction completed before the end of the year, and we're very pleased that we've been able to achieve that. I think, as you all know, we have three very clear pillars to our strategy at Telstra. The first is improving customer advocacy, the second is driving value from our core business, and the third is investing for longer term growth. And I think in relation to the investing for longer term growth, the Pacnet acquisition really ticks two important boxes there. One is our commitment to expand into Asia, and then secondly, our commitment to expand our global enterprise services business. We already have substantial presence in Asia. We have more than 1,400 people in the region, and that doesn't include a very significant and successful investment in Autohome, where we have another couple of thousand. We've got considerable infrastructure network to support our expanding services business, and this acquisition will substantially increase that. We also have significant sales and corporate development resources internationally, and we're going to continue to look for opportunities to invest in the region. What I'll do is I'll hand over to Brendon Riley, who will take you through the strategic rationale for the deal, and particularly how it fits with our global enterprise services strategy. And then Brendon will hand back to me, and I'll comment on some of the financial aspects of the transaction before we open up to questions, where I think we'll do first with the investing analysts and investors on the phone, and then we will hand over and cover some media questions as well. So again, thanks everybody for hooking in today. Sorry it's a little bit closer to Christmas than I think we would probably all like, but we're very pleased to get this deal done and announced. So with that said, I will hand over to Brendon.
Great, thanks Andy, and good morning, good afternoon everybody. As you know, we already offer integrated connectivity and services solutions across the region. This deal with Pacnet significantly enhances our presence in the region and accelerates our growth. And I think this is very, very important for what we're looking to do with global enterprise and services. The combined entity places Telstra in a leading position in terms of assets, people and capabilities, and it'll effectively double the size of our GES business in Asia. Our strategy is centred on serving enterprise and wholesale customers who connect with Asia. We believe the acquisition of Pacnet creates greater scale, presence and specialisation across Asia, all essential elements for our ambitions to grow and thrive in the region. In terms of network and geography, it increases the density and diversity of our reach across the Asian region and into the US. It provides strategically located assets such as POPs and data centres, and this also includes China. In terms of capabilities, it enhances our ability to offer new services such as software-defined network-based services known as SDN across a network of interconnected data centres. It almost doubles our talent pool, and it adds thousands of new customers, opening up a lot of incremental new opportunities for our business. A little bit more colour on Pacnet themselves. As some of you know, Pacnet is headquartered in Singapore, and they have over 800 staff across 24 cities in 11 countries and regions, from Australia into Southeast Asia, North Asia, as well as the US and the UK. The acquisition includes Pacnet's interests into China as well through its joint venture PBS, which stands for Pacnet Business Systems, which is licensed to operate domestic Internet Protocol Virtual Private Network, which is IPVPN, and provide data center and hosting services in China. Pacnet's assets comprise 109 points of presence, 29 data centers, and also submarine cables. Pacnet owns Asia's largest privately owned submarine cable network, which lands at 19 cable landing stations across Asia and altogether has 46,420 kilometres of cable. And it also controls 2 of the 5 fibre pairs on the Unity Trans-Pacific submarine cable connecting the United States to Asia. Their customer base includes more than 2,400 enterprise customers with a strength in financial services, the internet, social networking, e-commerce and professional services, and it does have a strong franchise in the growing OTT segment. They also have approximately 220 carrier customers comprising retail and wholesale telcos. In terms of their products and services and the breakdown of their business, and the percentages I'm giving you will be of the fiscal year 13 financial results on a revenue basis. Connectivity accounts for 32% of the business. That's international private line, international Ethernet and private wavelength circuits. Bandwidth comprises 26%, which is fibre optic submarine cable networks and associated operations and services. IP solutions is 26%. IPVPN, IP transit, internet access, content delivery networks, and SDN. What we would define as NAS solutions is 9% of the revenue. Managed router, managed application acceleration services, managed firewall services. And then data center, which comprises 7%, which is mostly co-location and some hosting. I just wanted to sort of close my remarks before I hand back to Andy and just touch on what I think all of this means for our customers. For Australian businesses across Asia, and importantly, companies looking to expand and grow in Asia, the combined entity will provide powerful new options for networks and services, including China. From a submarine cable perspective, the combined entity and planned upgrades will provide one of the most sophisticated cable networks into most critical landing points across Asia, especially from the US. And we believe this is and will continue to be highly attractive for OTT companies and large enterprises expanding into Asia. Demand for data centers with optimized networking is growing across Asia, and Pacnet will add another 29 interconnected data centers with the latest SDN services. Combining the cables and the interconnected data centers across the region, we believe this provides one of the most comprehensive connected backbones available across Asia. This core platform will enable Telstra to more rapidly scale and expand our unified cloud, unified communications, managed network services, and security services offerings into selected markets. And this has always been our strategy. And in the second half of this financial year, we will launch new unified cloud and UCaaS, unified communications as a service offerings, based on the very latest technologies from Telstra and our partners into selected networks. For Pacnet's existing customers, we believe Telstra's history in the region, our financial strength and strategy for growth across Asia will provide strong incentive to continue their relationship with us and capitalise on our global capabilities, advanced services, and also strength in the Australian market. And as we look to accelerate our growth in Asia, Pacnet also brings a wealth of talent, and we'll look to integrate and also restructure our business to ensure we have the very best talent in the industry, aligned to the goal that Andy mentioned of providing the best customer service in the market. Finally, we will undertake an extensive integration program, which is expected to take up to 2 years following transaction completion. This program will focus on sustaining and enhancing customer service, as well as looking for synergies to drive simplicity and main competitiveness in all markets. So with that, let me pass back to Andy.
Thanks very much, Brendon. Well, as you would have seen from the release that we made this morning, the acquisition price for Pacnet is $697 million US, and this includes gross debt of approximately $400 million. The acquisition we financed by cash reserves and existing committed bank debt facilities. As you know, we ended 2014 in a strong free cash flow position, notwithstanding the buyback and spectrum acquisitions that we made in the first half of this financial year. And as you also would have seen from the materials that we released to the market, Pacnet's revenue for its financial year 13 was $472 million US, and its EBITDA was $111 million. As Brendon said, we see this as a very important asset strategically for our aspirations for our enterprise services business and also our aspirations for expansion in Asia. We, as Brendon said, plan to fully integrate the business, and we're targeting run rate synergies of approximately $65 million Australian, which covers both OPEX and CAPEX, and we feel that's a pretty conservative estimate, which sort of arises from some of the overlapping infrastructure, albeit there's a high degree of complementarity between the two businesses, which is why we think this is very strategically attractive for us. And that doesn't include revenue synergies, where we think that the additional scale in the region will make us more attractive to wholesale customers and enterprise customers as well. So we think financially it's a very attractive transaction. It meets all of our investment guidelines. It will be EPS accretive by year 2. The return on invested capital will exceed our weighted average cost of capital at least by year 3, and it's more accretive than a share buyback of the same size. So that's the sort of high-level financial summary. I'm sure we'll take some more questions on that in a moment. But before I go across to questions, just a couple of points in relation to next steps. As you would expect, the transaction is subject to customary closing conditions, including regulatory and other approvals. We expect it to complete in the fourth quarter of this financial year, so obviously sometime between April and June of 2015. I've mentioned that we expect to fully integrate all aspects of Pacnet other than the China joint venture holding in order to capture the relevant synergies. And more importantly, it will be integrated into the international business of Global Enterprise Services, which Brendon's running. And we expect to hit fully all of the synergies within 2 years of completion. And I've mentioned we also see some further upside in revenue synergies as we integrate the two businesses. With that, I will hand back to Peter, who will then facilitate some Q&A. But thanks again, everybody, for hooking in. Peter.
Thank you, Andy. We'll now open up to questions from analysts. And Ange, are there any questions on the line?
Yes, there are. First question I have for you is from James Wang of Deutsche Bank. Please go ahead, James.
Hi, guys. Just a question around the strategic rationale again of owning the assets versus renting these infrastructure assets. If I just look at the submarine cables industry, you mentioned before that Telstra does have a pretty sizable network of submarine cables in the region, and there does appear, from what we've read, there does appear to be quite a bit of capacity that's coming on. And my understanding is it's quite easy to increase capacity by upgrading the equipment rather than owning these additional cables. And if I look at Pacnet's revenue, it's been declining and it's been making operating losses if you account for D&A charges over the last 2 years. So I'm just wondering whether you might be better off strategically renting rather than owning these assets, and if you could also perhaps step through, owning versus renting for all of data centers, submarine cables, and POPs individually, please. Thanks.
Brendon, I think I might take that one. So, firstly, when we looked at the total, economic equation, we felt it was very, very attractive with the Pacnet and the also the Australian Telstra-owned cable assets. If you look at traffic that comes out of the United States into Asia, there is a significant amount that will travel across these cable networks, and we think being able to, consolidate those assets as much as possible not only provides us with a strategic play to many of the over-the-tops coming into Asia, but also provides us with an opportunity to continue to drive synergies across all those cable assets. As I mentioned in my comments, we've got, through the work that Pacnet have done, software-defined networking connectivity across the major data centres. We've got data centre capability in China, so we also think that provides a highly diverse and very, very attractive set of not only cable landing points, but assets for people coming into Asia, doing business in Asia to leverage from. Strategically, we also want to be able to go up the stack more, probably than Pacnet has done. We've done that very, very successfully in the Australian market, and now what we've moved up the stack is worth over $2 billion a year, and we definitely want to leverage that and take that in. I think there will be some rationalisation of POPs and some of the assets. I think if we look at perhaps some of the data centre expansion plans that Pacnet had, we probably won't be going quite as far as they were originally intended. But overall, we're comfortable with the deal and the opportunity that it presents.
Right, thanks.
Next question.
The next question comes from Ian Martin of CIMB. Please go ahead, Ian.
Thank you. Two questions, if you wouldn't mind. First, Brendon gave a little bit of a profile of the customers, 2,400 enterprise customers, in terms of the kind of market segments they're in, finance, e-commerce and so on. But I just wonder how they compare with the current set of GES customers, at least the international customers in GES, and whether we're looking at a kind of expansion of the geographic expansion, if you like, of the customers that you might have found it hard to develop relationships and business services with through this acquisition. This first question, and secondly, you provided the revenues and EBITDA for FY13, and I'm assuming that it's a little bit lower in FY14. I just wonder if you could confirm that and what the kind of run rate is for FY14 on those two metrics.
Let me take the first one. I might ask Andy to answer the second one. But look, on the first one, I think what you said would be a good summary. It's very, very complex. The customer set is very accretive to our existing customers, and that's both the industries they're in, the locations they're in, and also the type of deals that they have. So from that perspective, we're very excited about it. They do have one, probably significant Australian customer, which is not a Telstra customer. So when you look at the Australian customer base, it's also one that we haven't highly penetrated. So for those reasons, it's also very positive story.
And just picking up, Ian, on the sort of financial question, and maybe I'll sort of comment a little bit on to the point that James was raising as well. So firstly, and specifically to your question, the performance in FY14 is certainly consistent with FY13, and anything is a further improvement. And there's no doubt that the Pacnet business has been going through quite a bit of transformation and improvement under the current management team, which is demonstrating itself through the improving EBITDA. So that's a journey that we will continue with them, and it's basically a sort of a business mix and just operating efficiency set of initiatives that have improved that. But it makes it ultimately a more attractive business. But in summary, FY14 performance is in line, if not a little better than FY13, which is a continuation of the trend over the last couple of years.
Thank you.
Thank you. The next question for you is from Raymond Tong of Goldman Sachs. Please go ahead, Raymond.
Afternoon, guys. Just a couple of questions from me. Can you maybe provide a bit of colour on the China joint venture PBS? I suppose what the opportunity is in that market. And secondly, can you give a sense of what the drivers are for the 65 million of synergies, the split between CapEx and OpEx? And maybe just finally, what do you expect the D&A and CapEx to be for Pacnet?
So maybe why don't I start out and take on the first question. So Pacnet and the joint venture that it set up with its partners, PBS, is one of the first, foreign, entities to be provided with licenses, domestic licenses in China. So they've got an IPVPN license for 23 provinces, and that's been given by the Chinese Ministry of Industry and Information Technology. There's 26 cell phone POPs across 19 major key cities in China. And then there's two major data centers, Chongqing and Tianjin, so one in the east and one in the west. And they're both, large data centers. And, the joint venture, and they've been established, in collaboration with the government in China, and the joint venture has the rights to buy those, in a few years' time. So overall, it gives us, I think, a very, very good backbone in China to support, our customers going into China, and also potentially to grow and shape the industry in China itself. I'll pass back to Andy on those last 2 points.
Sure. No, look, thanks, Raymond, and thanks for hooking in. Look, on the synergies, we haven't sort of broken it down between CapEx and OpEx, as you would appreciate. The majority is obviously OpEx. However, there are definitely some CapEx synergies which really arise as a consequence of reduced investment for cable investments and some technology investments which will be overlapping, so we'll save some there. If you look at Pacnet's long-term CapEx to sales ratio, it's been around 10 or 11%, and there's nothing sort of, in a sense, unusual in terms of how that accounting works. So from a depreciation and amortisation perspective, it flows through at roughly that sort of level as well. So you're looking at a business which has got gross revenues of $450 to $500 million, CapEx to sales of 10 or 11%. That sort of throws off D&A in the sort of $40 to $50 million range.
Great, thanks, Andy. Thanks, Brendon.
Thank you. The next question is from Harsh Agarwal from Deutsche Bank. Please go ahead with your question.
Hi, I had a couple of questions. One was on the regulatory approvals. Can you give us some more details on what sort of approvals you will need for the deal to go through? And do you see any kind of issues with the approvals? And the second question, I guess, was Pacnet has a very high cost, 9% bond outstanding. I guess it might be too early in the game to give an answer, but just curious to see what's your view on the bonds. I mean, the bonds are, I guess, callable at some point. So curious to see if you guys have any thoughts on the bonds that Pacnet has outstanding. Thank you.
Yeah, just on the first one, on the regulatory approvals, we will be working that very collaboratively with Carl Greidner, the CEO of Pacnet, and his team. With today's announcement out of the way, we will commence that. Look, I wouldn't want to preempt, any of the regulatory approvals, but I think we've got, both Telstra and Pacnet have got very good working relationships with the regulators across all the countries that we're dealing with, and we will work this collaboratively and move it as quickly as we can. So that's probably about all I can say on the regulatory approvals. But let me pass to Andy on the second part of the question.
Yeah, look, thanks, Harsh. And look, on the bonds, that's really something that we will tackle once we get into the integration process, and you'll probably appreciate why I wouldn't want to be drawn to sort of comment more on that at this stage. But it is something that we'll tackle in terms of thinking about how we sort of move forward once we get into integration.
currently is from Samir Chopra from Merrill Lynch. Please go ahead with your question.
Good afternoon. Looks like a pretty good deal, particularly post synergies. I had two questions. One, you will now have a bigger footprint to offer your some of your joint venture partners, people like BT Telecom and StarHub, etc. And I was just wondering, how does that change the relationship with some of these new JVs that you formed? And secondly, Brendon, could you give us a sense around how customers are starting to react to this? I presume you've had a few emails from customers. I was just wondering how they're reacting to this new offer.
On the first item, it would be fair to say that the Pacnet, one of the countries that it really doesn't have, it has a pot, but it doesn't have much, is Indonesia. And we will definitely be, working very, very closely with PT Telecom and with our joint venture there. And we think this will be a wonderful set of additional capabilities that we can not only bring into the joint venture and collaborate with PT Telecom on, but also it provides a whole range of new options for us to work with Telen, which is the international arm of PT Telecom. We do have, I think, a very, very good relationship with StarHub and some of the other major carriers across Asia, and I have no doubt that this will also help in our working relationship with them. Reaction from customers, I have to be really honest with you and say that unfortunately I've been on a flight most of today. I just sort of landed in time to take the call, so I haven't had a chance yet to personally speak with some of our customers. I know Carl has been keeping his customer set up to date with the discussions with Telstra, and from everything he's told me, there's certainly been positive. So,
thank you.
And if there's no more questions, over to Nicole and her audience.
I'm just checking that for you, so just bear with me one moment.
Sure.
Okay, I had a question from Mel Maiden of Fairfax Media. I'll just place him through. Go ahead, please, Mel.
Hi, Andy. You say that this deal beats a buyback. Can you just tell us to what extent that's a comment on the metrics of this deal versus the extent to which it's a comment on the metrics of a buyback and the way they are moving as Telstra share price increases to hit $6 yesterday?
Well, thanks very much, Mel. And just, I think, Nick, you were going to probably make some introductory comments as we went over to...
Yeah, sorry.
Why don't I take Mel's question and then I'll pass back to you and then we'll go from there. But firstly, Mel, thanks very much for hooking in. So look, the comment is, look, in our capital management framework, we have three very clear criteria for acquisitions. One of them is that we measure every acquisition against a buyback of a similar value. And so it is very much a comment on the economic attractiveness of the transaction, not a comment on the dynamic with Telstra's share price or otherwise. It's a very value accretive deal, and as you heard from Brendon, strategically very important one too in terms of building out our GS business in the region and also meeting our aspirations to expand into Asia.
Okay, thanks.
Thanks, Mel. And look, Andy and Brendon, I don't actually think we've got any other callers on at the moment from the media. We'll just check quickly back with the operator on that. But
there's only one hard-working media man, Mr. Maiden.
I can't believe that. Operator, do we have any other calls? And obviously, Andy, happy to take questions around the financials of the deal and as Brendan's been saying, talking about the context of the deal itself and what the business will bring to us. So just checking to see if we have any other calls. Otherwise, it'll be a very short one. And do have another media member online for Andrew Wright from The Australian. I'll just place him through. Go ahead, please, Andrew.
Oh, hi, Andy. Look, I just wanted a bit of context. Back in 2008 when these equity funds were investing in the company. It was valued at around $2 billion. I'm just wondering what's been driving the value of this company down, and what sort of plans do you have to arrest those sort of trends?
Andrew, I think that question may be directed at Brendon for starters.
Okay, sure.
Yes, yeah, sure. So look, I'm happy to take that one on. Well, one of the things that the equity owners did is they brought in a new leadership team under Carl Gryden, who's the current CEO, and over the last year or so, we've been in a lot of discussions with Carl and his team. So they've taken, particularly over the last 2.5 years, a number of steps to turn around the performance of the business, and that required them to exit certain services, assets, and locations. And so that's one of the reasons behind, the decline in the business in recent years, but that's contributed to, an improvement, a return to growth, top line, bottom line of the business, and, it puts it on, a good trajectory going forward. All of the meetings that I've had with Carl is still, a very, very strong pipeline of deals and opportunities, with their customer base. And as Andy mentioned before, we see the 13 results, sort of rolling forward into year 14, and that turnaround starting to play out. So I think there was a decline, and then I think we've had a new management team come in, and they've really turned it around. But through that process, they refocused the business, and that also accounts for a little bit of a reduction in the size of the business.
Okay.
Thanks, operator. Do we have any other calls?
Yes, we do. We have a few more in the queue. There's Max Mason of Fairfax Media with the next question for you. Please go ahead, Max.
Hi guys, thanks for doing the call today. First of all, can I just ask you a question around the regulatory things again? And please just, if I'm a bit ignorant on it, placate me. But do you need to go past the Chinese regulator, being that I think Pacnet has said that they're the only foreign-owned company licensed to have IP VPN services? And then, this is quite a large deal. Traditionally, well, in the last little while, you've kind of had bolt-ons and joint ventures. Given the limited availability of a lot of assets throughout Asia, should we expect that this is kind of a one-off, or are you kind of keeping all avenues open?
Okay, thanks, Max. I might ask. Sorry, go Brendon, and then I'll ask Andy to pick up some of that as well.
Yeah, no. Look, I think on the regulatory, we will definitely, take the appropriate steps across, all the major geographies. I think, any change of ownership, it's very, very important that we liaise with all the regulatory authorities across all geographies, and we'll definitely do that. So that will probably be my response on that one. On the second part of your question, and I'll also let Andy comment if he would like as well, there probably aren't a lot of, assets, like Pacnet, and I think that was one of the things that attracted us, to Pacnet. And as I say, we've been working with Carl and his team for some time on this. So whether we wanted to do another one like this, there just isn't one available. So you're now into, and as we've always said, country by country, we'll look at building things ourselves, we'll look at partnering, and we'll look at acquisition, and that will continue to play out. But in terms of something of this size and scale, I don't see there are too many options left.
And the only thing, the only thing I would add as well to that, Brendon, is, and that which may be more significant, as we've seen for many years, is very expensive from an economic standpoint. And so, we do sort of hold ourselves accountable to be very disciplined from an acquisition point of view. And one of the points about this transaction, it is quite value accretive, particularly measured against our acquisition criteria. So, we're very committed to continue to look for opportunities to expand in region within the GES business, as well as beyond GES, in the other areas that we've previously indicated that are of interest to us, and we wouldn't rule out doing a further sizable transaction. But to Brendon's point, they're few and far between, and those which potentially are there are also, you struggle to make them stack up economically as well. So,
Thanks, Max. I think we have another caller.
Yes, we do. From Financial Times, Jamie Smith, please go ahead with your question.
Hi. Could you tell me what percentage of your revenues are currently generated in Asia? And is there a Telstra plan to get this up to 1/3 of revenues by 2020?
Andy, I think I'll have you answer that one, please.
Yeah, sure. Well, look, let me respond to the latter one first. No, we don't have any proportional targets. What we've said is that Asia is definitely a region where we believe there are really interesting opportunities and where we have capabilities to leverage and add value. But ultimately, we're not going to sort of set ourselves targets in terms of proportional terms. We just look to grow all of our businesses to their maximum potential. In terms of the proportion of revenues coming from the region, currently it's less than 10%, and so therefore, hence the opportunity to increase our investment in the region, and that's one of our key platforms of growth in the longer term for Telstra.
Thanks. Can I also ask you, is Asia an easier place for you guys to do business in now than, say, it was just over a decade ago? Because I know you did a big write-off about a decade ago, about $1 billion, but is it an easier place to do business now for a telco like yourself?
I think what I would say is that there's a couple of strategic dynamics which are, I think, quite interesting and very much why our strategy is what it is. The first is our network application services business, which is part of the global enterprise services that Brendon is running, and he may well want to comment as well, is still a relatively young market, but we've been growing very, very strongly. So we have nearly a $2 billion business there, which has been growing more than 25% per annum over the last couple of years domestically in Australia. And that market is a fairly nascent stage right the way across the Asian region. So we believe we've got significant capabilities to play into that strategic trend. The second area is really around sort of more traditional data networks domestically, where most of the mobile networks, or rather most of the data networks or the networks within the region are typically sort of built and designed around 2G and 3G technologies, which are technologies designed for voice and SMS rather than for data. We've been one of the global leaders in terms of rolling out 4G networks, and we believe we've got considerable expertise in network design, network engineering. And so that's the other strategic dynamic that's playing out in the region at the moment. And so we think there'll be opportunities for us in that area as well. But Brendon, I'm not sure if you want to comment further on the
No, I think that's spot on, Andy. I mean, the only other thing that I would add is that when you go and look at many countries across Asia, I mean, Telstra has been in these countries for a long time. I know we were having a discussion about India earlier in the week, and it's interesting to see that we were one of the first telcos through a joint venture in India in the mobile space many years ago. So I think we've got great heritage, and to Andy's point, we're now taking, I think, a lot of the IT, the assets, the capability we've successfully deployed up the stack on our networks, and we're looking to more aggressively accelerate that across China. And when we look at a lot of the operators, in the region, I think, some of the capabilities we had are, right at the forefront of what's available anywhere in the world.
That's great. Thank you.
Thanks, Jamie. Thank you. Operator, I think we have Josh Taylor. Is it next?
Yes, you do. I'll just place Josh through. Go, please.
Hi, guys. Thanks for your time this afternoon. Just a quick question. It was rumoured a couple of years ago that a company that you're partnered with in Indonesia, Telecom Indonesia, was looking at taking over Pacnet. Did that have any sort of backdrawn on the takeover, considering your relationship with them? And I guess secondly, Is the best way to grow in Asia through acquisitions, or is it through organic growth? How do you sort of see that working together?
Just on your first question, I honestly have no idea. One of the things I said before to one of the other questions was that Pacnet just has a pop that has a very, very tiny presence in Indonesia. So we see this as being very, very complementary to what we're doing with PT Telkom, and so that would be my answer on that one. And sorry, your second question again was
just how do you see growing in Asia? Is it through organic? Because this deal essentially, you said it doubles the size of Telstra in that particular region. Is organic growth any factor of it, or is it just all going to be through mergers and acquisitions?
Well, if I can just talk about GES, and I'll ask Andy to talk more extensively on the rest of the business. But what we've been doing is looking at each market, looking at the offerings we believe will play in that market, and then we're making a decision about whether we're partnering, whether we're building our own capabilities, or whether we're going to go and acquire. So obviously, one of the advantages with Pacnet is it starts to fill out a number of those cells in a lot of countries that that we don't have today. But I would see it as being a combination of build, partner, and acquire going forward.
Great. And just to add, Brendon, I think I see the same more broadly as well. I think in the end we've got a very clear view of what we want to do in Asia, and I think we have to be flexible, and we'll be both look to execute acquisitions as well as organic growth as well as partnerships.
Thanks, Josh. Okay, operator, I think we may be done, or do we have one more?
There's one more question from Mel Maiden of Fairfax Media again. I'll just place him through.
We'll let him have one more.
Thanks, Mel. Go ahead, please.
All right, thanks for that. Moody's said in August that the Pacnet had some interest payments coming out towards the end of the year. I think they said it was $20 million or so. That the owners may have to tip money in because its liquidity was stressed. Other interest payments coming up. It's now in this sort of interregnum between the ownership change. Are there any monies owing? Is there any kind of balance sheet rejig needed between now and the formal change of control? And if so, how's it going to be managed?
Look, Mel, so I'm obviously very aware of the Moody's analysis. We're very happy with the position of the company. Obviously, its debt levels are much greater than we would have within the context of Telstra, but it's generating positive free cash flow, and it's in a position to continue to trade on that basis. So there's no immediate issues in that regard, but I think the business will be substantially helped by being part of the broader Telstra organisation.
Yeah. All right. Thanks.
Thanks, Mel. Thanks, everyone. I think we'll wrap that up there. We're right on time. Thank you, speaker to the operator, and we really do appreciate your calling in today so close to Christmas, and apologies for that. But please do contact us if you have anything further to ask. So with that, thanks very much and enjoy your Christmas.
Merry Christmas, everybody.
Thanks, Tom.